Welcome to Yahoo Finance Live. I'm Shauna Smith along with Dave Briggs. Now let's get everyone up to speed with what they need to know. An hour to go in the trading day. A sense of stability returning to the markets with banking fears taking a back seat, at least for now. The focus shifting to the path of monetary policy ahead of the Fed's next rate decision in May. We will take a temperature check on where things stand.
Plus, Senator Bernie Sanders roasting Howard Schultz in a heated hearing, criticizing the former Starbucks CEO of running the biggest union-busting campaign. We'll speak to a union organizer who testified at today's hearing later in the show.
And finally, one Wall Street analyst saying that Amazon is unlikely to buy AMC. Wedbush's Michael Pachter giving us his hot take in the 4 p.m. hour.
But first, let's get you up to speed on day 2 of the bank hearings on Capitol Hill. Top banking regulators testifying today before the House Financial Services Committee over their department's role in the collapse of Silicon Valley Bank and the fallout from it. Yahoo Finance's Jen Schomburger has all the details. Hi there, Jen.
Dave, once again, House lawmakers trying to get to the bottom of what happened and why Silicon Valley Bank failed. In 5 hours of questioning and a hearing that is ongoing, Republicans and Democrats on the House Financial Services Committee both agree the Federal Reserve should have done more to prevent Silicon Valley Bank from failing.
Your Senate testimony, in which you basically said it was bank mismanagement for them to ignore the good advice your people gave them. It is also misregulation to let banks ignore that advice. You are not running a consulting operation. You are running a regulatory operation who can force banks to follow that advice.
In a series of questions from committee chair Patrick McHenry, it became clear that regulators at the Federal Reserve, Treasury, and FDIC became aware of the distress at SVB Thursday before it collapsed, but that there was difficulty evaluating collateral from the bank and pledging it to the Fed's discount window in time to get funding. FDIC Chair Martin Gruenberg said he understood that the bank would fail Friday morning or evening, but did not begin the auction process for SVB until Sunday afternoon.
I've heard none of you three accept real responsibility for your role in this endeavor.
I think we need to take a good, hard look inside at the Federal Reserve, at our supervision, at our regulation. I think we need to be humble about that. And I think we are going to be unflinching in our review.
But both parties disagreed on what should be done to prevent it from happening again. Democrats argued a 2018 Trump-era law that rolled back the strictest requirements for banks the size of SVB was to blame. When asked whether rules under that 2018 law should be rewritten, Barr said that he will take a look at that as part of his review. Barr said it doesn't have to be the same rules for all banks, but that stronger rules are needed for firms of SVB's size on capital and liquidity. Barr said, quote, everything is on the table. Republicans said the Fed has all the powers it needs to hold banks accountable without changing capital requirements. Back to you.
Indeed. Jen Schomburger, great job. Thanks so much. To discuss what lies ahead for the banking system, let's bring in Wedbush Securities Managing Director of Equity Research, David Chiaverini. David, good to see you. Do you feel better? Do you feel worse? Or do you feel the same about the banking sector after the last couple of days? And do you have any big takeaways?
Yeah, I feel about the same as I did a few days ago, because frankly, more stringent regulation may not have solved what occurred. My view is that banks really have to take it upon themselves. They know what the guardrails are. They know what the rules are. They have to manage within those rules. And if they misstep and make a mistake, look what happened. Those banks shut down. The management teams are out of a job. And those are the consequences. Now, with all of that said, I am expecting a few things to come, out of these hearings, and especially in the wake of the disruption of SVB and Signature Bank. I expect liquidity coverage requirements could go up, capital requirements very well could go up. And an important one is unrealized losses on securities portfolio are excluded from regulatory capital, we very well may see a new rule where those unrealized losses may have to be included in regulatory capital calculations. That way, what happened with SVB, a red flag would have been raised much sooner. So those are the few main things that could come out of this.
But David, do they need additional regulation to catch what happened with SVB? And that was at the core of the last couple of days. And again, Jen laid it out pretty well. Democrats say more regulation is needed, and Republicans say they had everything they need. What say you?
Yeah, I would say that the existing rules are sufficient. And my view is SVB really got out of line with their interest rate risk management, and they paid the price for it. So I think that other banks immediately are going to be carrying much more liquidity on a go-forward basis, and seeing what came out of this with the fallout. Banks that were kind of teetering on the edge of the liquidity requirements are going to keep much more liquidity on hand going forward. So I'm not expecting any wholesale changes to come out of this. The few things I mentioned, are probably on the table, but I'm not expecting any of them to actually go through and be changed.
David, what's your reading just across the board when it comes to regional banks? Are you still confident that they are positioned well, that maybe some of the fear that we have seen within the banking system, that has simply been much to the overblown side?
Yeah, so mixed views in this regard. So the stocks have pulled back, of course, significantly. Call it, 30% on the KRX. Today, we published a report where we took down our earnings estimates about 7%. So based on the magnitude of the stock moves, it does look like we could be ripe for a rebound in bank stocks, especially as we get through earnings season. Now, I am expecting net interest income guidance to come under pressure with the earnings releases next month. But looking out further, 6 to 9 months down the road, I am expecting the credit availability is going to start to constrict GDP growth. That very well could lead to slowing loan growth. It could also impact credit quality for the banks. So longer term, I'm still cautious on banks, but it does look like the group is positioned for a bit of a rebound here.
Not cautious on New York Community Bank. You have upgraded to outperform from neutral. Why, and how does it differ from others in that class of its peers?
Yeah, so New York Community, they were in a really prime position to acquire the assets from Signature Bank, of course, one of the failed banks, and they got a sweetheart deal. They acquired $12.9 billion of loans at a $2.7 billion discount, and then they also took on $34 billion of deposits. So that puts them in really good position to have EPS accretion over the next few years, and now they also have a bit of a halo effect. The fact that they're working with the FDIC to rescue this bank, I think that any depositors that might have been fearful of moving their money from a mid-sized bank like New York Community to one of the money centers may not feel as compelled to do so, given that they've done this deal with Signature Bank.
David, what about lots of the concerns around First Republic Bank, questions just in terms of what exactly their future looks like? What do you think's in store?
Yeah, First Republic, different story. Clearly, they faced some deposit pressures given all the borrowing that they've done from the Fed. And my expectation is that when we see the deposit numbers come out for March 31st with their earnings release, we're going to see deposits be, down significantly. And I'm expecting, given all the liquidity that they've brought on, I don't see them going into receivership from here. What could happen, though, is earnings power is likely significantly reduced because their balance sheet is likely to come down. So all of the borrowing that they took on, they pledged their loans and securities to get those borrowings. So as the principal pays down on those securities and those loans, it'll go to pay down the borrowing. So the balance sheet is going to shrink. We expect that their costs base is going to have to be restructured. We very well could see some layoffs to get the company in a better position from a profitability standpoint. So earnings power really being under pressure here is the main story with First Republic, and it's likely to occur over several months and quarters as opposed to over the next couple of weeks.
And David, real quick here, so that's the story with the smaller and mid-size regional bank plays. What about the larger U.S. banks? Because as we've seen deposits flow out of these smaller players, a lot of those are being allocated to the larger banks. Which one, in your view, is best positioned?
Yeah, so the money center banks, which we don't cover, but nonetheless, clearly, JP Morgan, Wells, Citi, Wells Fargo, I'm expecting all of them to really be net beneficiaries from all of this because they are viewed as too big to fail. So they're going to have all the deposits at their disposal that they need. And if anything, their capital requirements may become an issue from the standpoint of too much deposits coming in. We've heard Jamie Dimon say in the past that they had to turn away some deposits because of the various regulatory capital ratios, but they are clearly in a very different situation than the mid-sized banks.
Very different indeed. All right, David Chiaverini of Wedbush, always great to have you. Thanks so much. Former Starbucks CEO Howard Schultz testifying in front of senators today over accusations that the coffee chain waged an aggressive and illegal union-busting campaign under his leadership. Those words from Senator Bernie Sanders. Our Brooke DePalma has been following that hearing all day. Brooke, some fiery exchanges between the senators and Howard Schultz. What stood out to you?
Well, certainly lots stood out to me. In a more than 3-hour hearing that took place today, Schultz responded to questions across the aisle, some rewarding his and the company's success, others calling him straight up wrong. Committee Chairman Bernie Sanders hit the ground running, accusing the coffee chain of illegal union busting activities.
On the other hand, we have a corporation worth some $113 billion, largely controlled by an individual worth some $4 billion, who are using their unlimited resources to do everything possible, legal and illegal, to deny these workers their constitutional right to form a union.
Now, from the get-go, Howard Schultz, who stepped down as CEO last week, said he wanted to set the tone that Starbucks has not broken the law. And when asked by Senator Sanders if he could agree to exchange proposals with the union within 14 days of the hearing, Schultz responded that the company has been trying to do that, but has been met with challenges.
Because the arrangement that was made by the union and the NLRB in Buffalo to negotiate one single store at a time, we have met over 85 times for a single store. We've tried to arrange over 350 separate meetings. We've said publicly, and I say it here again, that we believe that face-to-face negotiations is the way to proceed. And the reason I want to make that point is that there have been safety issues in which Starbucks managers have been outed on social media. There are privacy issues. We don't want to do it on Zoom. We are prepared to meet face-to-face on a single store issue.
And in response to Starbucks' hometown senator, Seattle-based Senator Murray, Schultz said he believes that a person at Starbucks has the right to decide if they want to join a union. But Starbucks' vision is a preference to maintain a direct relationship with partners, which it calls its employees. And later on, one of those partners took the stand. That was Maggie Carter, and she works at one of the first locations to unionize in Knoxville, Tennessee. She responded on why she felt encouraged to unionize.
The wages and rent rising in our state, it's just not something that worked for us. And also benefits are just too expensive for us to actually be able to use. So rather than forego a paycheck, we just choose not to have health insurance. So those are a lot of the reasons why we chose to organize. And I'll say Howard Schultz does not feel like a partner to me.
Now, Schultz does remain on the board, but these issues largely fall under the scope of new CEO Laxman Narasimhan, who took the helm last week. And as of now, there have been no conclusions reached. But Wall Street not reacting too much to this, shares up just 1%.
What happens next?
Yeah, that's a great question. That's something that I asked an analyst on Wall Street of Wedbush as well. And he particularly said that this is a small amount of companies. It's only more than 290 of 9,000 U.S. company-owned stores at Starbucks. And so Starbucks will keep coming to the table. They want face-to-face. Then the unions have to agree, the stores rather, that voted yes to unionize. And he said that it may take a long time for these companies, rather these stores to reach a conclusion, to reach some sort of agreement. But he also noted that this is baked in. At some point, this comes an incremental cost of business to Starbucks, and that it's going to be baked into margins, valuations, and expectations. So lots of fallout from this.
And Bill Cassidy, Republican senator, wanted to make clear that they have some issues with the National Labor Relations Board. They feel they have politicized this fight and have taken a side here. So that will continue that fight as well. Excellent reporting. Thank you, Brooke. Good to see you.
All right, let's get a check in here on the markets. With 45 minutes to go in the trading day, we're seeing gains across the board. The Dow up 271 points, S&P up just over 1%. You look at the Nasdaq as the leader today, up just about 1.7%. In terms of the sector action, all 11 of the S&P sectors trading to the upside. Top performers so far: technology, real estate, and consumer discretionary. This market check sponsored by Tasty Trade. We're just getting started here on Yahoo Finance Live. Coming up, more people are buying homes. Pending home sales rising for the third month in a row, month-over-month basis in February. Realtor.com chief economist Danielle Hale will tell us what's in store for home buyers this year. And the AI race is on as tech giants battle for dominance. We'll tell you who Wall Street says is in the lead, at least for now. Don't go anywhere. Bank stress has been rattling Wall Street for weeks, but investors looking past that risk, at least today. All three of the major averages gaining. Tech, the outperformer of the afternoon. Look at the Nasdaq up nearly 2% right now. We want to bring in Jim Schmigel, SEI Chief Investment Officer, here to break down today's action. Jim, it's great to see you again. So certainly it seems like investors more comfortable. I don't know if that's the best way to put it, really, with all the stress that we have been seeing in the banking sector and putting that at least on the back burner for now. How are you looking at that and the fact that the market continues to be so resilient?
That's right. Thanks for having me, Sean. I mean, if you would tell the average investor that we've just lived through one of the largest bank failures in history, that the banking sector itself is down year to date 18%, say that the S&P would be up 5%. I think you would get a few unusual looks. It is an unusual market that we're in today. A lot of kind of bifurcation, if you will, confidence in those mega tech names, with the Nasdaq 100 up 18% on a year-to-date basis. It feels as though there's this kind of relief rally kind of coming into play, but still with this tinge of cut into safety. Investors are still seemingly flocking to what they perceive to be safer names in light of all of the uncertainty surrounding the banking sector itself.
Given that we may see yet another Fed hike coming up and this environment, the uncertainty, what do you make of the flee to tech?
It's interesting. I think you're right. I mean, this does have a lot to do with a repricing of interest rates. So the market has taken quite a bit out of Fed expectations, both from a terminal rate perspective, market more or less pricing in maybe one and done here, but more importantly, rate cuts here. Roughly 3 rate cuts priced in. Very, very unusual. We're on the other side of that. We don't really see that happening. But these more interest rate sensitive parts of the equity market, like mega tech, are the ones that are benefiting from that interest rate outlook, which is just decidedly dovish. And quite frankly, in our view, a little misplaced relative to what we expect to see from the Fed through the end of the year.
All right, Jim Schmigel, always great to get your perspective. Thanks so much for joining us. We're having some connection issues, so hopefully we get that worked out next time we have you on. Good seeing you. Let's do a quick check of the market, sponsored by Tasty Trade. Again, you're looking at gains across the board. The Dow up 309 points, S&P up 55 points, Nasdaq up 212. We were just hearing from Jim just in terms of the sentiment shift, technology being one of the outperformers of the year. Communication services also not too far behind for the day. You're looking at all 11 of the sectors trading to the upside here. So we'll see whether or not we're able to hold on to gains.
All right, some cautious optimism on the housing front with some new numbers in the housing data today. February pending home sales rising for the 3rd consecutive month. They're up 0.8% from January, but still down 21% year over year. Joining us now with more insight into the housing market is Danielle Hale, Realtor.com chief economist. Nice to see you, Danielle. We've asked this question more times than we care to remember, but is the worst behind us? Because it is entirely unclear when you dive inside the data.
Yeah, so my expectation is that we have seen the low in existing home sales. That doesn't mean it's going to be a straight shot up from here. I do think we'll see some ups and downs in home sales in the year ahead in response to what happens with mortgage rates. A lot of home shoppers at the edge of their budgets as home prices remain high and mortgage rates remain relatively high. What happens to mortgage rates is really going to impact whether people can move forward with their home purchase decisions. And so I expect that we'll continue to see that home shoppers are sensitive to fluctuations in mortgage rates moving forward.
And Danielle, in this economic data that we just got, and also in Realtor.com's, your guys' data, there is certainly a discrepancy in terms of where we are seeing hot markets and where some markets are underperforming. How does the East Coast stack up against the West, and where are the most popular areas, at least right now?
And so in general, markets that are doing better right now as far as sales and pricing activity are out in the Northeast and in the Midwest and the South, where homes are relatively more affordable. The West Coast has not fared quite as well. In part, it saw some rapid run-ups in home prices before, but also it is a pricey area. And so that affordability equation is harder to square out there on the West Coast. And so we're seeing a bit of a pullback in activity out West, whereas the other regions saw an increase in pending home sales activity in the latest data.
Boy, that gives you a real good look at how relative real estate is. Mortgage rates, we'll get Freddie Mac Thursday, but Mortgage Bankers Association has them at 6.45% on the 30-year. Where do you see them heading from here? Because that also has been conflicting in recent weeks.
Yeah, I mean, we're at the stage in the cycle where the data is really important. And so if the Fed can, in fact, get to the end of the tightening cycle with one more rate hike, maybe 2, then I think that gives mortgage rates some room to move down. But if inflation is stickier and persistent, and if the Fed has to ratchet expectations up again for how long its short-term rate is going to need to remain elevated, then that means we could see mortgage rates pull back up again. So I think we're going to see mortgage rates fluctuate between 6 and 7% as the future kind of comes into clearer focus. And so we're going to see a bit of up and down in the home sales activity in the year ahead in response to those mortgage rate fluctuations.
Danielle, what about the inventory picture? Because that has certainly been a huge topic, obviously a big issue if you're one of those home buyers looking for a house right now. When do you see that improving, and what's it going to take?
Well, it is improving. It just hasn't improved enough, maybe for most buyers. The market is certainly not a buyer's market because in most markets, we're still looking at much more constrained inventory conditions than we saw before the pandemic. In fact, nationwide, there are still only about half as many homes for sale as was the case before the pandemic. On the flip side, though, home inventory is up really significantly compared to last year. So it's a bit of a glass half full, half empty, depending on what your comparison point is. The good news is that we're moving in the right direction. So we are seeing more inventory on the market available. The sort of downside of that good news is that it's because homes are sitting for longer. So there's less churn in the market as opposed to a lot of seller enthusiasm. And we think that higher mortgage rates are, again, playing a factor there because a lot of existing homeowners have locked in very low mortgage rates. And so it's less enticing for them to make a move if they would also have to take on a higher mortgage rate. Now, existing homeowners who have largely paid off their mortgages and so have very low balances or may even be able to make a purchase in cash, they're less affected by mortgage rates. And so those are the types of buyers that we're seeing active in this market. Now, the exciting thing is that we're moving towards the best time of year for home sellers when you think about the seasonal conditions that we see in housing. So that's going to create some opportunities for homeowners going forward. If they do choose to participate in the market, we're getting very close to the best time of year to list your home for sale.
Then when is the best time to buy a home?
When is the best time to buy a home? So it depends on your situation, but seasonally, buyers generally have the best balance of opportunities in the fall, sellers in the early spring.
All right, excellent information. Danielle Hale, appreciate that. Coming up, analysts at UBS are bearish on several retail stocks. We'll tell you which names on the other side of the break.
Shop Talk. It's one of the biggest annual retail conferences of the year. All the big retail names are here. The Silicon Valley giants, Amazon, Google, and PayPal, and the giants of Main Street, from Foot Locker to Walmart. These are the three main trends we spotted here at the conference. AI, aka artificial intelligence, is having its moment as the ultimate buzzword in the field of investing, and AI is definitely on display here at Shop Talk 2023 as tech companies try to work with retailers to monetize a lot of the big data they are collecting in real time. AI very much on the minds of people we spoke to here.
I think as we see this next generation of AI, it is really powerful. And so I think one of the most important questions out there is, what are people going to ask the AI to do? And are people asking the AI to do things that are positive and helpful, things that are additive, which is where we're focused, is making sure that we're making really helpful recommendations for people that help them build a life they love.
We dramatically innovated, invested in what you would call automated storage, retrieval systems, state-of-the-art shipping sorters, state-of-the-art technology that allows us to pick, pack, ship, etc. And having now been 3 years into the journey, we're seeing improved safety, we're seeing improved productivity, and lower cost structure.
The second major trend here is shipping, and there's a race on getting all those products you buy online to your doorstep even faster. Here at Ship, they're trying to get you your packages faster than the next person. In Target stores, oh yeah, Target owns Shipped. In Target stores, there are Shipped employees picking goods off the shelves, putting them in a box, and delivering them right to your home. 22 billion packages are shipped every year in the United States. UPS, FedEx, and the Post Office ship nearly all of them. The size of the package delivery market is expected to hit $157 billion this year, helping to explain the focus at Shop Talk on delivery solutions. And the third big trend here at Shop Talk is buy now, pay later. With the economy under pressure, buy now, pay later services like Affirm and Klarna have a big presence here at Shop Talk 2023. According to a recent survey, more than half of all consumers in the US said they are currently using a buy now, pay later service. The average loan is $883. Clothing, electronics, and furniture were the top 3 items financed. Until next year, Shop Talk. By then, AI will only be faster and even smarter.
Time for Triple Play. 3 stocks that we're watching in the final 30 minutes of trading. We've got Apple, Foot Locker, and Pepsi. Let's start it off with Apple setting a date for its annual Worldwide Developers Conference. That's going to take place at its headquarters in Cupertino, California. It will be June 5th through the 9th, 5 days of this event. Now, the big headline this year is that we could get a new product from Apple, and with reports saying that the company may unveil a mixed reality headset. We've talked about this in the past, lots of debate about how big of a hit this will or won't be here for the tech giant. Now, if they do it will be one of the biggest product launches that they have launched in quite some time. Remember, it's been, about 8 years since the smartwatch, 6.5 years since the AirPods. To no surprise, Apple is drumming up some excitement for this event, calling it, quote, our biggest and most exciting yet. The headset is going to reportedly be a high-end product that could cost as much as $3,000. Apple's very excited about this. Obviously, no surprise there. They want this coverage. The headset, I'm not sold that it's going to be a huge hit here for consumers.
I'm not excited yet. But I will say I wasn't excited about AirPods. I still don't have an Apple Watch, but I know plenty of people that do, and people have come around to the concept of wearing that instead of a nice watch, right? And I think even when you think about going all the way back to the computers and the initial Steve Jobs story and people not really wanting the kind of Mac they were making, isn't that just Apple's story, right? Is they're kind of giving you what you're not ready for yet? And then you realize once you have it in your hands that it is something that you want, and they're gonna have to convince you that way, right? You're gonna have to get it in your hands and be convinced, I think. At least I am.
No question. I remember thinking with the iPad, why do I need a bigger iPhone? Unfortunately for this is a massive oversell, right? I mean, we've seen every indication that we're not ready for AR. We don't care about the metaverse. No one's going to the metaverse. Mark Zuckerberg is cutting back spend. Disney just wiped out an entire unit. Not buying this. What I am buying is if they can come out with a new iPhone, and that's not till September, then maybe that can be a catalyst for some excitement. But the early reviews from those in the Mac world say there's not a whole lot of changes in line for the iPhone 15, perhaps a different plug, which is certainly not going to excite you and make you run out to the Apple Store.
I think the question with that, though, will be, how does the iPhone 15 potentially connect with this maybe AR headset, right? Because I think that's how they've gotten me with products in the past, is they get you in the ecosystem and they connect with the phone. And if there's a cool feature where you're on FaceTime and all of a sudden you can make it so the person that's on the headset is in the same place you are and you're a traveler or something like that.
You said you weren't sold. It sounds like you're pretty sold on this.
Well, as the younger person here, I'm going to try and pitch you guys on the tech.
I'm not even believing what you're saying, man.
All right, we'll try them out in June or August, whenever they come out. We'll have to see.
Yeah, $3,000.
Nice effort, though.
Yeah.
All right, you guys are selling the headset. UBS is selling some retail names. Let's take a look at some of those retail names today, specifically Foot Locker, Urban Outfitters, Ross Stores, and Burlington, all catching downgrades and sell ratings from UBS in a note published today. Analyst Jay Soul warning of a consumer spending slowdown impacting those companies. Specifically with Foot Locker, Soul points to Nike's emphasis on direct-to-consumer sales, impacting Foot Locker's share of Nike sales, as well as Foot Locker's consumer likely coming under pressure as the economy tightens. Overall, Soul pointed to apparel spending and how that has not been nearly as resilient as, say, travel or other areas. Now, UBS data matches what recent card data out of Bank of America shows, as consumer spending on B of A cards has declined at a steady pace throughout the start of this year. But, Dave, I do want to end on a positive note here. So they are still bullish on some names, Nike, Deckers, On Holding, and Skechers. And really, the highlight there is that the high-end consumer will keep buying, and also a lot of those companies are very good at footwear. High-end consumer footwear is going to continue, so those companies are well positioned there versus some of the other companies we named at the top there, like a Foot Locker, that doesn't have nearly as much of a high-end consumer, might not hold up.
Yeah, Nike caught a 2% move today. Under Armour, not mentioned, up 4%. So benefiting from some sort of wins there. But what jumped out to me about what Jay wrote is, to many, a recession significantly weighing on soft goods sales is a bear case. But for us, it's a base case. And that was, I know you ended on a high note, and I took it right back down to a very low note. A base case of recession is something we haven't heard in quite some time, and not something that any of us are excited to hear, certainly not in the investment space.
No, certainly not. And a lot of that was based on the spending data that UBS has been tracking now for quite some time. They're seeing a pullback much more earlier and a much bigger pullback than they were initially expecting. You would have to think even some of those names that he still has outperformed ratings on wouldn't be posting as strong of a numbers if we in fact do get that recession.
Yeah, we hope he's wrong on the recession. Okay, my play, PepsiCo, who owns Lay's potato chips, among other products, and rolled out a potato-themed promo this week. And yes, I bought props. This spud, as you see it, is also a ticket. It's a ticket if you bring a potato tomorrow, and I'm not joking, if you bring a potato tomorrow to a participating Regal Theater location in LA, New York, Chicago, Atlanta, Dallas, or Houston, you can exchange said potato for a free ticket to Dungeons and Dragons, Honor Among Thieves. This all, again, a Lay's potato promotion. Watch.
This spring, Holga doesn't love to be disturbed while she's eating her potato. Kind of the highlight of her day. An unlikely hero will emerge. We're gonna need a team. We're gonna need strength. We also need courage, magic. We're really counting on him.
A potato.
I feel like this is a joke, but it's actually real, and obviously it worked. Here I am talking about it. PepsiCo is up fractionally today, but up 8+% over the last 6 months. This is a promo I did not see coming. I really want to see it play out on Twitter. I'm dying to see people show up with potatoes at a movie theater. And yes, Josh Schaefer wants me to take a bite out of this.
You have to bite it. You have to bite it like the character,
How much did
right?
that cost you?
I don't recall. Do you think I can bite into a potato?
It's $1,
try
right?
it, yeah.
Isn't the potato about $1?
Aren't they too
I
hard?
was going to say, I feel like it was more than $1. Okay, how was... You don't even have to do that as part of the promo.
But I think you should have to make it an actionable thing. You got to show up with the potato and bite it.
Why did I do that?
I think they bit that a little bit early.
Early, exactly.
I was thinking maybe at the end.
Yeah.
But
I don't know. This is a smart play on their part. They're doing stuff. They're going to pack the theaters $1 rather than how much does it cost to go to a movie theater in New York? You've gone recently.
Yeah, it's about $15.
$16.
It's a steal, man.
A steal. Yeah. I bet. Are you going to do it? You should do it.
To see Dungeons and Dragons, no, which would be my only critique of the deal, is just.
The reviews have been good though.
Yeah, I just think that's a tight audience. That's a tight audience for people that probably like that game in that area.
90% among the fans and 94 among the critics. That's a tremendous rating. Here, you can take that. And you can bring that potato.
You want me to bite it too?
No, I want you to bring that potato.
I'm going to bring a half-bitten potato.
To the movie.
Do I get half a ticket, you think?
We will see. Well, you got to do it. Only one way to find out.
46 years, I've never taken a bite out of an uncooked potato.
Yeah, I can't say either of us are jealous.
I will never do it again.
Yeah, no.
It's not bad. It's just really not good.
It's not worth it. Josh, well, that was a very easy.
I knew that would take a turn, and it sure did take a turn. You're welcome, everybody.
All right, well, we got to leave it there. Josh is taking the potato to a movie theater. We'll see how it works out for him, whether he can get into the movie for free. Coming up next, though, turmoil gripping the banking sector has investors concerned where to put their money. We've talked about it next.
We're nearing the end of the first quarter and checking in on ETF investments so far. Year to date, ETF flows are $90 billion, according to VettaFi. Joining us now is Tom Lydon, VettaFi Vice Chair in this week's ETF report brought to you by Invesco QQQ. Great to see you, sir. Inflows at that level tells you what lies ahead.
Hey, David. Yeah, okay year so far for ETF flows. We're running about $90 billion. It puts us about $360 billion for the year, which is drastically under last year where we had $600 billion. A couple surprises. We've seen some nice equity flows. However, the key thing is more money has been going into international equity ETFs than domestic ETFs. And a lot of that's because of the valuations that you're getting overseas. We are seeing a pickup in demand for fixed income ETFs. And a lot of that might be tied to the Fed and the job that they're doing so far in battling inflation.
All right, well, Tom, it's the Final Four this weekend. So much hype around the games that are going to take place starting on Saturday. So we asked you to break it down, the top 4 ETF plays that you see for the rest of the year. And we have a bracket here to put up on the screen highlighting the four ETFs that you see as outperformers for this year. So let's start off the top left-hand corner, Vanguard Total Bond Market ETF. Why do you like it?
Yeah, well, first of all, the Fed has done a pretty good job so far, and a lot of advisors and investors are going in with the idea that they may not see yields as high as they are a year from now. So going longer and lower credit quality is something that you can get in a diversified bond ETF. This is the biggest bond ETF out there with $90 billion. However, I think it would lose out to the biggest regional bank ETF. I mean, this ETF is down 30% off its high from early February. I think when we look back and see what's gone on, there are a few outliers that maybe, whether it's creative accounting or lack of oversight, might have spoiled that pool for the rest of us. Hopefully, there's a little bit more confidence in that marketplace. I think we're going to see this market come back. And most importantly, during times of rising interest rates, regional banks actually make more money than on the lending side than their bigger bank brothers who make money, yes, in lending, but more also on trading and investing. So I would say the SPDR Regional Bank ETF, KRE, will win out on that one.
Yeah, we've been focused on that one just about every day. I would equate those two to kind of the Miami Yukon side that could have seen that coming. On the other side of the bracket, I did not see coming the Florida Atlantic San Diego State. And there you have Wisdom Tree up against gold. Tell us about that matchup.
Yeah, I think Wisdom Tree would be Florida Atlantic. And again, with the camp out that Xi and Putin had recently talking about Putin's support of the Chinese yuan. I mean, putting that into perspective, the core global currency is the US dollar. Most central banks have about 60% of their allocation to the US dollar compared to only 3% to the Chinese yuan. This move is not going to really move markets at all or cause any type of stress. So I don't really feel that the Chinese yuan is really something to invest in long term. It might get a little bit of a bump from this, but the reserve currency will continue to be the US dollar. And you put that up against gold. Gold recently peaked above 2,000. We all know that. It tends to also be a second half player during times of inflation. And there have been plenty of times when inflation has lasted not just a couple years, but 5 or 6 years. I think we may be in that situation. And back to our friends over in Russia, in selling dollars, what do? They bought 1 million ounces of gold. So central banks are continuing to do that. It comes down to supply and demand. And when you look at demand, it's all around jewelry demand across the world. And also during times of uncertainty, we also see more demand as well. There's only so much gold out there. It costs a lot to get an ounce of gold out of the ground. And frankly, gold hasn't done anything in 10 years. It was the worst performing commodity that we've seen over the last 3 years when commodities in general did well. So I think it's gold's time. If gold doesn't do well during this period of time, I think we're all going to be wearing Bitcoin necklaces in the next couple of years.
All right, Tom, so we've got the final matchup up on the screen, the championship here, the regional bank ETF KRE versus the gold ETF that you were just talking about, the bullish case there, GLD. Who's going to be the champion?
Yeah, I think it's going to be gold. I've got a lot of faith in regional banks coming back. I think we're going to see some of the big banks actually going in and snapping up some of these regional banks. However, gold is an asset class that's been with us not just for decades, but for centuries. And to the fact that it really is expensive to get gold out of the ground, which is going to help increase the price of gold. This is the time for gold. And I think between now and the end of the year, we're going to see gold have a pretty good move.
You got to tell us who wins the real Final Four. You got UConn, you got Miami. Who you got?
I actually saw Connecticut and Gonzaga last week in Las Vegas. Connecticut looks really, really strong. I'd go for Connecticut.
Dan Hurley, yeah, they dismantled the Zags, didn't they? Tom Lydon, always great to see you. Terrific work on the Final Four of ETFs. Coming up, some of the biggest leaders in tech are urging AI labs to pause development on artificial intelligence training. We've got the details for you on the other side of this break. Elon Musk is urging us to push the pause button for 6 months on AI. In an open letter from the Future of Life Institute, Mr. Musk, along with Apple co-founder Steve Wozniak, 2020 presidential candidate Andrew Yang, and dozens of other tech leaders, writing, quote, "Powerful AI systems should be developed only once we are confident that their effects will be positive and their risks will be manageable. These are certainly valid concerns, but Elon Musk, This guy might be the last person on the planet who should deliver this message. Take, for example, Tesla's fully autonomous driving program, the subject of a class action lawsuit before a San Francisco federal court. I asked ChatGPT what concerns it has about Elon's autonomous cars, and it told me, quote, there have been several accidents involving them, some of which have been fatal. There are concerns the technology is not yet advanced enough to ensure safety for passengers and other road users. Chat cited legal and regulatory issues, even ethical concerns around how decisions will be made in situations where there are no clear ethical solutions. This letter also asks, should we let machines flood our information channels with propaganda and untruth? Where have I heard that before? Has Elon scrolled Twitter since he took over? It's literally a breeding ground for propaganda and untruths. So maybe just sit this one out, Elon. As for a 6-month pause, consider that ChatGPT amassed 100 million active users in 2 months, the fastest growing consumer app ever. Pumping the brakes now on AI after the entire tech world has put the pedal to the metal is not feasible. It's the biggest investor story in years, maybe decades. Bill Gates himself just called it as fundamental as the creation of the internet or mobile phone. There is no putting this multi-billion-dollar genie back in the bottle. And Shauna, as the letter from Bill Gates wrote, we do need some meaning for guardrails here. But is Elon Musk the one that should be delivering this message? Maybe if he was not on that letter, I could take it more seriously.
Yeah, I am very surprised. And like you said, Dave, it is very ironic that he was one of the signees here of this letter, because you raise a good point. There certainly has been a lot of misinformation, a lot of concern about some of his technological advances in the past, a lot about what the information that he himself has put out on Twitter, that Twitter platform in general displays on a daily basis. But we've heard this nervousness, these questions about AI. We had the Chamber of Commerce, a representative from there, on the show a few weeks ago when they were urging for AI regulation. So I think there is a lot of merit to this argument, but you're right. Given the fact that so many companies are jumping on board here, given the fact that ChatGPT was extraordinarily popular, would you say 100 million users by the end of January, that is just incredible and really shows the popularity and really the growth potential of this technology.
A little more irony. You know, Elon Musk is one of the founders of OpenAI, which created ChatGPT. So he wants to kill his own monster in a sort of way. But look, there are valid concerns about AI. Will they replace jobs? Certainly they will replace some jobs. But again, it's just too late to put this genie back in the bottle. So what they should be urging is meaningful guardrails. And the tech community to get together with government and figure this out, come up with some sort of council to figure it out, because pausing it is a ridiculous notion.
No, and even just look at the reaction that we saw in so many of the earnings reports, earnings calls from the last quarter. Any company, most companies that mentioned AI, you saw that stock take off the next day. So it's something that's certainly resonating with Wall Street, resonating with investors, and I don't think any of those companies are going to be slowing down.
Just got an email from Open Table about how your dinner reservations will use AI, and an email from my grocery store about how you can do grocery shopping with AI assistance.
Everywhere.
It's too late now.
It certainly is. All right, well, coming up, we are counting down to the closing bell on Wall Street. Stick with us.
We are just a few minutes away from the closing bell. That's time to bring in Yahoo Finance's Jared Blickery to break down the market action. What do we see, my man?
We got some green on the screen, and we're looking at the highest closed in the majors for a couple weeks, and that's the Dow, the S&P 500, and the Nasdaq. Dow just under 1% there, though Nasdaq up 1 3/4%. All 11 sectors in the S&P 500 in the green. Starting with real estate, tech also outperforming, consumer discretionary, financials, utilities, industrials, and materials. All of those are outperforming. Healthcare taking up the rear. That is a defensive sector. So interesting to see real estate and tech in the leadership spot. But you take a look at our leaders in sentiment markets here, just about everything in the green except for Korean stocks. Now, meme stocks, those are up 4%, followed by ARC Disruption. And what we've seen in the past is a lot of times these moves get started and then we don't get a lot of follow through. So that's going to depend on what happens in the dollar and the majors tomorrow. But for now, we're looking at Peloton up 6%, GameStop down 3%, and the list goes on. But looks like it's time for the closing bell.
It certainly does. Well, that does it for today's trading day. All three of the major averages ending in the green. The Nasdaq was the outperformer there. And we're looking at strong gains across the board when it comes to some of those larger cap tech plays. Amazon among the outperformers there. When you take a look at some of the other leadership playing out in the market, real estate, the top performing sector today. Also financials among the outperformers in today's market. So some of the concerns that we certainly have seen in the banking sector seem to be subsiding just a bit. And this market check sponsored by Tasty Trade. All right, let's take a look at some of the big movers of the day. First up, we got to take a look at Lulu closing sharply in the green, up nearly 13%. The company beating fourth quarter earnings expectations and offering upbeat guidance for the fiscal year. Wall Street also liking what they saw in this report. Citi upgrading the stock today to a buy from neutral analysts. They are saying that the company is, quote, checking all the boxes. Dave, I exchanged some emails with Adrienne Yee from Barclays, and she was saying her quarter to date checks, what they're seeing right now in the current quarter, is very, very strong. So really reiterating, backing up the guidance that we got from Lulu after the bell last night. Lots of worry going into this report about whether or not they were going to be able to deliver, given the fact that we've seen a pullback in consumer spending. But it doesn't look like they're seeing it, at least not too much.
High-end consumer, still spending, still traveling, and Lulu benefits from that. There's some stuff. It's a good report, but a $500 million essentially hole on Mirror, which was clearly now a terrible buy. The inventory levels still up 50%. They got a bit of a handle on it, but still a big issue, and many feel a lot of discounting ahead because of that. And look, the bottom line is how you feel about Lululemon depends upon how you feel about the price of this stock. It is expensive, man. We talked to Morningstar analyst David Schwartz about that. Here's what he had to say.
Lululemon has a tendency to put out kind of low numbers that it can beat. And so, I think I'm going to be raising my numbers, and I think most analysts will, perhaps even above Lululemon's guidance. So it is a company that has a history of beating estimates. You look at the valuation, I do think that Lululemon is overvalued at these levels. I don't necessarily like it at this price. It often is traded at PEs over 50 at times. It's no longer that expensive, but you're still talking about a pretty high PE for a clothing company. And really, I wonder if Lululemon can continue to post these great numbers year after year.
To some of you, their clothes are too expensive, and to many investors out there, the stock is just too expensive. But not Stifel's Jim Duffy reaffirmed a buy, raised the price target to $460, which still implies 27% upside on this stock. Man, it's pricey. They continue to put out good numbers, but that is a high number to pay.
It is, and you would have to think that Lululemon will see some pullback here over the coming quarters. It's hard to imagine that we'll see that large of a rally in this stock here, at least in the next 12 months. But hey, maybe they are right. Their digital division there, sales there, digital gain at 39%. So certainly they are seeing a lot of traction in that part of the business. And taking a look at where Wall Street stands on this stock, 25 buys, only 6 holds, and 4 sells. So that really tells you many analysts see upside potential from here.
Wowza. All right, Rivian shares closing higher today after Needham came out with a bullish call. The analysts feeling positive about the risk reward going into first quarter deliveries, which are likely to be announced next week. Analyst Chris Pierce says that a Cox Auto Industry Insights call earlier this week showed a higher estimate of newly registered vehicles for the first quarter, higher than predicted, Shauna.
Yeah, certainly. It'll be interesting to see in terms of what is going to be that huge catalyst. If they do exceed those delivery targets, obviously that would be the catalyst here in the near term, but lots of questions about whether or not they continue to ramp production, continue to meet some of the goals that they have outlined. The company does say it is on track and wants to deliver on its 50,000 unit goal for 2023. We know that goal had been revised a few times in the past, but Needham's price target, $26. That's almost double of where Rivian was trading today. So we'll see lots of questions just about the cost-cutting initiatives that's happening right now at Rivian. We know that they have announced 2 rounds of layoffs, so they're trying to get their house in order, but we'll see.
Yeah, layoffs in February that were 6%. Cash burn is a huge problem there. They are running out of cash. And to your point earlier, they got to double production to meet their goals this year. That is a tall hill to climb. There was another catalyst. Some feel this U.S. deal with Japan on critical EV materials also kind of boosted the stock price a little bit today. And again, much like Lulu, analysts love it right now. 15 buys, 5 holds, 2 sells. So a lot of upside, say the investors on Rivian right now.
All right, let's also take a look at Micron. It posted its biggest quarterly loss on record as a weak market for PCs and smartphones weigh on the company's financials, but Wall Street was actually optimistic on this print, and here's why. They thought that these most recent results and their outlook here signaling that a turnaround is ahead and maybe the worst is behind us here for the chip industry. We know that Micron announced that they were going to be cutting jobs. They initially planned a cut of about 10% of reduction here for their workforce. That's now going to be a 15% reduction in their workforce. So a number of analysts, though, despite the fact that we saw a lot of optimism on the street, at least today, a number of analysts still cautious just in terms of the tough environment that remains here for a number of the chip makers.
Again, a remarkable look from analysts there. 28 buys, 9 holds, 2 sells. What you hear really a consensus is this is not a right now story. This could be potentially a long wait. For example, BOA just says, well positioned, but no quick fix. And JP Morgan says there is potentially a light at the end of the tunnel. So this is probably not a next month, the next 2 months, next quarter story, but probably the next fiscal year at some point, that turnaround. And in part, look, you measure it by the leader in the space, which is NVIDIA, up 87% year to date. So it pales by comparison, but certainly some upside if you're willing to wait, if you're willing to be patient, at least according to the analysts. And eventually, we've talked about the CHIPS Act for quite some time, but the money has not begun to actually flow. We talked about it many months ago. They have not delivered the cash yet, and they do stand to be a big beneficiary from the CHIPS Act eventually.
Certainly. All right. A good stock to keep in mind here. Well, so a Substack post speculating Amazon could buy AMC sent shares of the movie theater chain soaring yesterday, closing off just about 3% today. But a new research note out from Wedbush telling investors that they don't see the acquisition as likely. Joining us now is one of the authors behind that note, Michael Pachter of Wedbush, Managing Director of Equity Research. Michael, it's great to see you again. So you're saying that this deal, this potential deal, is unlikely. Why doesn't it make sense?
Yes, Shauna. I'm wearing my Lululemon shorts, by the way.
Oh, there we go.
I don't cover them, but my last several Christmas and birthday and Father's Day presents have been Lululemon, so it's a great brand for men. Look, you really have to think about whether they are a willing seller. I think not, and whether there are any rational buyers out there. Amazon has behaved irrationally in the past, but never making big multi-billion-dollar mistakes. The biggest acquisition they ever made was Whole Foods, and that was a $4 or $5 billion revenue company that was profitable, and Amazon strategically needed it to get into home grocery delivery. This doesn't make sense. I mean, AMC is currently valued at around $800,000 per screen if you look at their enterprise value. And the going rate in the industry pre-pandemic was about $250,000 per screen. So, if Amazon just wants to buy screens, conveniently, Cineworld has given up its sale process and they're going to go into liquidation. They have about 10,000 screens for sale. My guess is Amazon can buy those for $200,000 a piece. So the whole chain may be $2 billion. Far more likely they'd buy 10%, 1,000 screens, get whatever they need strategically to make creative talent feel good that their movies produced for Amazon will get theatrical exhibition, and save the extra $7 or $8 billion and put that into something equally stupid like Amazon Ghost Stores. But they're not going to buy AMC theaters and turn them into convenience stores. You may have noticed that movie theaters have no windows and not very many doors, so probably not happening anytime soon.
Good to see you, sir. So the article report referenced these theaters as marketing way stations. Does that make sense? Taking out your breakdown, does that make sense as a concept for Amazon? And you mentioned Cineworld. I was wondering why that stock was popping earlier, up about 10%. So clearly investors think there might be some smoke where there's a fire where there's smoke there. Could that be a purchase?
No, I mean, the fact is that it's much easier to buy assets from creditors in liquidation than it is to take over the whole company and then guarantee the debt. There's no point in Amazon buying a company that has debt. They can just buy the assets from the creditors. If Cineworld fails in its process, and it looks like they're about to announce that, then the assets just go to the creditors. These big boxes have no value as marketing way stations. The person who said that is an idiot. So I'm sorry, am I allowed to say that?
Yeah,
just
you
a complete idiot. People hardly go to them as it is, but if they do, Amazon can market to your cell phone. They don't need you to go to a theater to realize that Amazon's out there. The assets don't have any value beyond as movie theaters. They're special purpose construction, mostly in malls. The mall operators want them as a traffic driver. You can't convert that into a dress barn. You just can't do it. So no, I don't see any reason Amazon would ever buy out Cineworld. But the pop is because people read, these posts and think that there's some, actual credibility behind them. This is an idiotic concept. I would downgrade Amazon if they did something as stupid as buy AMC for full value and take on the debt. That shows that Andy Jassy's completely out to lunch and has no idea what he's doing.
So fair to say that you are not supportive if this deal were to ever be reached.
I'm not supportive, but I love Lululemon.
There we go. You love Lululemon, hate the idea of Amazon buying AMC. Michael, what about AMC just being a potential takeover target in general? Putting Amazon aside here, would that make sense for anybody at this point?
Yeah, again, I did M&A for the better part of 15 years. I literally have done over 200 deals. I used to be a banker. And, for a deal to get done, you have to have a matching of expectations. You have to have a buyer who wants the asset and a seller who thinks the price is fair. Sure, AMC is a seller at some price, but who's the buyer? And the fact is, it's a declining business, so there's not really that much opportunity for a financial buyer. The going concern value is $800,000 per screen, and I'm confident that someone could buy Cineworld for $2 billion instead of buying AMC for $8 billion. So why pay $8 billion when you can get the essentially same assets for $2 billion? So no, if there is a buyer, they're going to pounce on Cineworld. Cineworld's been in bankruptcy for a while, and they've been looking for a buyer and haven't found one. So if they can't find one, why is Amazon suddenly far more interested in AMC? And just as a reminder, Cineworld owns Regal Cinema, so they're just about as big as AMC in the U.S., and they're bigger, in Europe. So it just makes no sense whatsoever that someone would buy AMC and take over their debt instead of buying Cineworld out of bankruptcy.
Amazon, though, did spend or is committed to spend $1 billion a year on north of 12 movies, full features at the theater. They bought MGM, $8.5 billion. What's the investor? Is that a catalyst at all for the stock? Could they spin off an entertainment side of Amazon at some point?
I doubt that they would. If Amazon were inclined to spin off anything, it'd be AWS, because that has standalone value. I mean, that's a really valuable business that you could separate from Amazon Core. No reason to be out there buying entertainment assets solely to spin them off later. And remember, the MGM deal got these guys Epics, which they just rebranded MGM Plus. So, it got them a subscription streaming service. That's a great vehicle for them to actually charge if they make, if they create movies, charge for content, charge subscribers, and put some stuff on MGM Plus, some stuff on Prime Video, and some stuff on Freevee, which is ad supported. So I think they have a multi-pronged approach to exhibition of film. And you said, a dozen for $1 billion, which is probably not the right number. That's 80 million per film. That's not big blockbuster type movies. That's more, Ben Affleck, J-Lo kind of movies. So romantic comedies for 80 million. You're not going to make Avatar for 80 million or a Marvel film for 80 million bucks.
I will be first in line for Ben Affleck and Matt Damon when Air comes out, though, next week. Michael, good to see you. We really encourage you to be honest with us next time. Really get it out there, my friend.
Lululemon.
You're so reserved. All right. Pleasure, as always. Coming up, the fight over Starbucks unions heats up on Capitol Hill. One former employee who spoke at today's hearing tells us what he wants to see happen next.
If they really want to be partners with us, they'd hear those concerns, and they'd make those changes, and they'd feel so. Starbucks has an empty seat that they leave at the shareholder table for their partners. They fill that seat and hear what we have to say.
That was Jason Saxton, a former Starbucks employee and current Starbucks Worker United union organizer, testifying today in front of the Senate Help Committee over accusations of union busting from Starbucks and its former CEO, Howard Schultz. Jason joins us now, fresh off his appearance in front of the senators. Good to see you, man. Do you feel like you made your case and you were heard today? Any progress made?
Absolutely. I definitely feel like we were heard today and we were able to make our point and, just tell not only the senators, but Howard Schultz as well, this is what's happening, and these are the things that we want changed, and we hope you come in and hear us.
Jason, I want to play for you a quick bite of what we heard from former CEO Howard Schultz today, what he had to say about the negotiations and how he wants to handle, or he would like to see Starbucks handle the employee relations. Let's play this, and then I'll get your reaction on the other end.
Starbucks Coffee Company also has the legal right to provide a vision for our employees, which currently represent 99% of the 250,000 who wear the green apron, that our vision is a preference to maintain our direct relationship. And in terms of what you said, as I said to Chairman Sanders, those are allegations, and Starbucks Coffee Company unequivocally has not broken the law.
Jason, what's your response?
So, he can sit there and he can say that that's totally his right. Unfortunately, they're not just all allegations. Some of them have been found to be with merit. So at some point, he's going to have to reckon with that. And when he does, I hope he, apologizes and begins to actually bargain with us, because I have not had a single bargaining session at my store.
Some people see this story from the outside and they say, hey, I get my coffee every day, and these people are making $15 an hour minimum, average $17 an hour. That goes up to $23 an hour. 2 or more years service, you get a 5% raise. Those with 5 years or more get up to a 10% raise. And everyone's offered health benefits provided you work 20 plus hours. A lot of people see that and say, that seems like a pretty fair deal. Why is it not?
So, for one, you have to make the benefits hour cap, which you said, the 20 hours. It's almost impossible to make that when at the same time Starbucks can easily cut your labor hours. So with that, like I said in the hearing, I have a partner at my store who went down from 25 hours to 5 hours. So that person is at jeopardy of losing their benefits.
Jason, what are the negotiations like? What have they been like when you have talked to Starbucks executives? I don't know if you've had any interaction with Howard Schultz himself ahead of today, but what exactly has that process been like?
So I have not met Howard Schultz. The executives have not come to bargain with my store at all. So I can't really attest to that. But from what I have heard from other people who have had at least one bargaining session is that a few minutes in, they get up and they leave. And that's it. They don't want to bargain with us. As much as they tout that they are bargaining in good faith, they're walking out of meetings just because someone's on Zoom.
Yeah, much has been made of that particular aspect here, Zoom versus in person. Why is that such a sticking point?
I don't know why that's such a sticking point for Starbucks. I mean, like was said in the hearing, the shareholders can come to the meetings through Zoom, but for us workers, we are expected to show up face to face with them. And these are the same people who have been intimidating and telling us, that we could lose all of our benefits, threatening our livelihoods. Some of us don't want to go and sit face to face with that.
Jason, do you expect any of these interactions, any of the approach here to change from Starbucks under its new CEO?
I hope so. I hope the new CEO is watching the hearing today, and I hope he heard us as well as Howard Schultz, as well as the senators, and he has a great opportunity to correct the ship and just listen. That's all we're asking, is just listen and come to the table with us and give us the respect that we deserve.
At the center of this is the National Labor Relations Board. Are they at the center of this? Do you feel like they have a side that they are rooting for in these negotiations?
Honestly, I think that's just a distraction. The NLRB is a neutral organization who rules over these cases neutrally.
Congressman Bill Cassidy, calling it a smear campaign against Schultz and Starbucks based upon allegations, in his words, that everyone knows are still under litigation. Jason Saxton, we appreciate you taking the time. Thank you. Coming up, Democrats and Republicans are wrestling over the debt ceiling. Find out what needs to be done and how quickly when we come back.
fiscal state of our nation is certainly unsustainable, but not unfixable. That window, I believe, is closing. The president had the opportunity to set a new course and provide real leadership earlier this month with his budget proposal. Instead, his vision calls for the highest levels of sustained taxes, spending, and borrowing in the history of our country, even by Washington standard. It is a budget binge of catastrophic proportions.
That was Chairman of the House Budget Committee, Jody Arrington, addressing President Biden's recent $6.9 trillion budget proposal. Now, this would add $1.8 trillion to the deficits as Democrats and Republicans struggle to come up to an agreement on the debt ceiling. All this against the backdrop of the Fed's fight with inflation and turmoil in the banking sector. Here to break it all down, Committee for a Responsible Federal Budget President Maya McGinnis. Maya, it's great to see you. First, just your reaction to what you heard from the hearing today and the impact that this is ultimately going to have on the federal debt.
Yeah, I think it was an important hearing today. So Chairman Arrington was trying to bring attention to the fact that the overall state of the nation, the fiscal state of the nation, is poor. And there's no disagreement on that when one looks at the numbers. President Biden put out a budget that would save $3 trillion, and I think that's an excellent start. Nowhere near close enough to actually tackle the big problems we have. We'd still be borrowing almost $20 trillion over the next 10 years, but at least there's savings instead of additional new borrowing. But we have so much more to do in terms of dealing with our trust funds, dealing with our growing interest payments, dealing with the fact that we'll be spending more on interest than defense or Medicaid. Clearly, the situation that we face is grave, and we have to get serious about addressing it.
Should entitlements be on the table?
Absolutely. Unfortunately, I think what we saw at the State of the Union, where the president has talked about not touching benefits for Social Security and Medicare, and Republicans have gone along, and President Trump used to say the same thing, all are at odds with the reality that Social Security and Medicare face insolvency in their trust funds in roughly a decade. Changes have to be made. Now, there are many options for how we make those changes, but I think that the use of the bully pulpit to promise what you will not do or take things off the table and frankly pander in a way that gets people stirred up isn't helpful at all. What you really need is for the president and members of Congress to level with the country and say, we are promising more from these programs than we're taking in revenues. There are a number of ways that we can fix them, but fix them we must. And every year that we delay, it's going to add to the cost. And we've already delayed for so long, it's going to make it harder than it had to be. So yes, the pandering we've seen on Social Security and Medicare probably plays really well at the voting booth, but it's not smart, it's not right, and it's not productive when it comes to policy.
Well, we found out Republicans don't want to go anywhere near it as well, given how that exchange went at the State of the Union address. And given the 4 years of out-of-control spending of President Trump, isn't spending a bipartisan addiction at that point? Can one party really claim fiscal discipline?
Oh, it is absolutely a bipartisan addiction. Spending has gone up under both administrations and administrations in the past. And actually, tax cuts, while Republicans tend to like them more, Democrats have had a lot of unpaid for tax cuts as well. And so when one testifies for Congress, the first thing that the two parties start doing is pointing figures at each other. And first off, that is not a way to work. That is not a professional way to behave. It really does feel like children at a time when things are so important. But second off, there is so much blame here to go around. We are now in the habit of not paying for new policies. We have not made the changes to the structural imbalances that are there. And while it's so important that we do borrow during times like COVID or a big financial crisis, we then have to get in the habit of running much smaller deficits, if not budget surpluses, once the economy recovers. And again, you are right, neither party has taken the lead on that. Neither party has been responsible enough. And we have a mountain of debt to show for it. And in a very polarized situation, it's hard to imagine how they're going to turn this fiscal ship around and start working together. But that's the only way we'll get this done. It will have to be bipartisan, and all policy options will have to be on the table.
Maya, how realistic do you think a default is? Because when you take a look at the market's reaction, they're showing little concern. And much of the commentary here from a number of well-known economists, they don't seem too concerned, at least now.
Well, first, I would say that markets have been pretty poor at predicting crises before they happen. But I am not as pessimistic as that sounds. I don't think we're going to default. I think we're going to figure out a way to both come up with some savings, which we definitely need, but not do it, hopefully not on the debt ceiling, around the debt ceiling, certainly with no drama to the debt ceiling. So I think we can get this package done, but I have never thought there was an actual chance of default before. And this time I do think there is a chance, and that it really puts a pit in my stomach to say that I do worry whether it's because there's some people who are just unwilling to do what we need to do to get the debt ceiling increased, particularly if savings are going to be a part of it, or inadvertently that they will stumble into a default, and that would be catastrophic for the country and put our sort of good standing in the global economy in jeopardy for absolutely no reason. So what we should do is come up with a way to generate new savings. And what we should do is increase the debt ceiling, which is merely paying the bills for laws we've already passed with absolutely no drama and no threat of default. And we should start running the fiscal situation in the country under sort of better governance, where we really understand you can't have a situation where your debt is growing faster than your economy nonstop, your interest payments are hitting records, national records, and just go along the same way we have for the years in the past. That's what got us into the problem, and we do have to make changes.
No question about that. Appreciate you noting that the debt ceiling is about bills passed, not about future spending. Maya McGinnis made some excellent points. Appreciate that. Coming up, incoming Lyft CEO David Risher tells Yahoo Finance his company is, quote, ready to fight for ride-sharing supremacy. Hear what else he had to say when we come back. Lyft is ramping up its rideshare battle with Uber, announcing that co-founders Logan Green and John Zimmer will be stepping back from their day-to-day roles leading the company. They named former Amazon executive David Risher as the company's new CEO. And earlier, our Rochelle Akufo and Brian Sazi spoke with Risher about his top priorities when he takes the helm next month.
Listen, our top priority is getting a great experience to our customers. I mean, to a certain extent, it's a focus on the basics. Make sure we pick you up on time. Make sure when you open our app, we're priced in line with the other guys, and get you where you want to go. And you know what? Rideshare is a big deal. It's really improved people's lives in so many ways. And I'm kind of okay with your calling it, the battle is back, because we're ready to fight and hopefully do pretty well.
David, Brian here. Good to see you here, and congrats on this appointment here. Now, you've been on this Lyft board, so you are familiar with the company. What has gotten Lyft to this point, and what do you need to course correct?
I think the thing is we got to focus. We have to really focus on rideshare and our customers and our drivers. In a way, it's very simple. The more passengers and riders you have, the more drivers want to drive. The more drivers want to drive, the faster your pickup time. So as long as we're doing a really good job on those basics, that's going to get, us part of the way there. And then, of course, there are questions that I know you're going to want to ask about where we're going to go in the future. I probably won't be able to say too much about that just yet, but we've got a lot of big plans already brewing.
And I know you said, now is going to be that time for that battle. We know you don't want to really compete with Uber and its existing services. So what would the plan be if you're not going to compete in those same spaces?
Well, look at what Uber's doing. So Uber has decided, I think their business model depends on being able to deliver, pizzas and, tuna sandwiches and packages and all kinds of other things. The problem that I see with that is, as a rider, I'm just not that excited about getting in the car with the tuna sandwich. And as a driver, the idea of double parking, outside the restaurant and getting a ticket, and then it's just a different thing, and not getting paid as much, by the way, as you do for rideshare. So I think to a certain extent, this is still a very young market. We're still talking about fractions of people, and by the way, fractions of activity because of COVID. And I think over time, as more people get out, as more people come back together, there's a lot of room for both of us. And I think if we stay focused on rideshare, we're going to do really well.
David, your first 90 days in, how will you immerse yourself in the business? Are you going to be, we've talked to John Zimmer a lot in recent years. He's been driving these cars. He makes, he says, look, I'm out there driving these cars. I'm connected with drivers. Do you plan to do the same, and have you done the same?
Yeah, I haven't yet. I did get my car inspected this past weekend. Good news, it passed. And I also passed the background check. So, I'm well on my way. But look, that's one of the great things about John is he's been so passionate about making sure he really kind of understands the details of the business. I'll be doing that. I'll be, of course, meeting with employees, as you do. Been talking a lot to investors and to the press to make sure people understand that Lyft is back and that customers have a real choice right now. And, and I almost hate to bring this up proactively, but I'll do it. Look, efficiency is also in the air. And so we've got to focus on doing the absolute most important thing so that our drivers and our riders get the best possible experience at a price that's in line with what the competition offers.
On efficiencies, David, now Lyft has been very aggressive in cutting expenses. Do you see more opportunities to do that? And then secondarily, some data out this morning by on the sell side saying some trends in your business have started to stabilize towards the end of the quarter. Anything you can share there?
Can't really share there. I think you kind of understand why. But I will say that for the last 15 years, 14 years, I've been running an organization that has to solve big problems, in this case around literacy for world reader, but with very, very small budgets. And so I'm very, very comfortable with the idea that, honestly, sometimes you can sort of get twice the team, without twice the people. So we're doing a lot of work there to try to figure out how to get our costs as good as they can be.
And I know you do a lot of focus on the customer experience. And during the pandemic, you had a lot of people working from home. At this point, still expecting some sort of long-term hybrid work experience. How will you then grow the company from here if that is going to be the longer-term trend?
Yeah, it's interesting. Of course, there are going to be hybrid work environments. There's no question. That's the new reality. But I would say, if anything, I'm feeling a bigger push to say, let's get people back out of the house and back to work. And that's not just sort of a philosophical thing. It's a practical thing. Decisions can be made faster. Mentoring happens more. At a time where consumers are under so much financial pressure, companies like us have to work really hard to make sure we're providing the best value. And frankly, a lot of the time that happens with people together in front of a whiteboard. So, I sort of think, it's a mistake to think that we're going to be cloistered in the future. And not that you said that, but I actually think over time, more and more people will want to get out and back together. That's where the magic happens.
To drive that magic, you need drivers, David. Do you have that access to the labor pool that you need?
We do. Driver supply is always an issue. The truth of the matter is, if you pay well, and we for sure have to focus on that, drivers tend to come. It's interesting. I had a great ride with a driver in Atlanta, and he said, what I love about driving for Lyft is I'm never going to go broke. I'm never going to go broke. I just have to drive. And same with the guy here in San Francisco, Luis, great guy. He said, look, in construction, I made $600 a week, and that was the top. I couldn't go above that. There just wasn't more work than that at my level. But I can drive as much as I want. And then in 2 weeks, I have the control to be able to go to a bachelor party. So I think for drivers, actually, there's a lot of upside for them still.
And so how do you plan on perhaps streamlining some of these costs while also improving pricing power, not just for the drivers, but also for the customers as well?
Yeah, that's my challenge, but I'm up for that, right? And I think, people think in trade-offs sometimes, but I think this is one where you don't get to choose. You both have to be price competitive. You have to be priced in line with where the other guys are, and you got to deliver a great service. And that's just, like so many businesses, you just have to figure that out. And we're very focused on making a profitable company long-term. So that's my challenge.
David, what do you think the end game is here for Lyft? Is it part of another brand, another company, another tech player?
Look, we always look at options like that, and people approach us from time to time. But right now, our focus is on creating such a great service that in whatever configuration, we're going to be relevant, valuable, either as a standalone company or something else. Look, remember too, you guys just ran a segment on electric vehicles, which of course leads to autonomous. As autonomous vehicles happen and you start to see, interesting experiences within rideshare where maybe it's not a driver in the front seat, but a barista, all sorts of fun things can happen, or a karaoke bar, I don't know. But if you sort of look way, way out, rideshare networks like this, like ours, are going to be really, really valuable.
All right, terrific interview there with incoming Lyft CEO David Risher and Rochelle Akufo and Brian Sazi. All right, Shada, so no tuna sandwich in a car. I agree with him there. If I get in a car and there's the smell of tuna sandwich, I'm out.
I do,
You're
but
getting
a pizza I would be okay with.
No, you're just going to get hungry.
I don't know. It's not too bad.
I agree with him on that.
I've been in some cars that don't smell a little funky here and
Good
there.
interview, though, man.
It was a very
good interview.
Good interview. We look forward to having him back, hopefully, on Yahoo Finance here in the future. Let's take a look at some of these movers after hours. We have two names for you: RH Restoration Hardware and EA Electronic Arts. Kicking off with RH, you're seeing that stock under pressure here, off just about 5.5%. A disappointing quarter for the company. Also, some commentary on spending here is shaking investors just a bit. Well, they missed on both the top and bottom line. Their full-year revenue guidance also coming up a bit short. In a letter to investors, CEO Gary Freeman writing, quote, "Data points to business in our sector likely getting worse before it gets better." Year to date, you're looking at the stock off just about 8%. Over the last year, you're looking at losses of about 36%. So another consumer play here under pressure and really worried about what the next couple of months could hold. Let's also take a look at EA Electronic Arts here. Trading just to the upside, right above the flat line. A big headline coming out from this company after hours, making some workforce changes. They're looking to cut about 6% of the workforce as they restructure some of their teams. Now, the company is saying that they also are going to reduce some of their office space as part of these restructuring plans. Now, they are going to expect to incur approximately $170 million to $200 million in charges because of this plan. Not seeing much action here in extended trading, but over the last year, you can see EIA stock under a bit of pressure, off just about 7.5% gain.
All right, Shauna, thank you. Coming up, a recent poll shows that a majority of Americans would support the federal government banning TikTok, but that doesn't mean it's any closer to happening. Rick Newman tells us why next. TikTok has been feeling the heat from lawmakers in recent weeks, especially during last week's hearing on Capitol Hill, with some pushing for a full-out ban of the social media app due to national security concerns. And a poll of American adults conducted last week revealing that more than 60% of Gen Xers and baby boomers would be in favor of shuttering TikTok in the U.S. Yahoo Finance senior columnist Rick Newman is a TikTok star. He is a legend. Are you even on TikTok?
I think I have an account, but I do what everybody says, which is don't put it on your phone, which means therefore it's useless, right?
Yes.
It's not on your phone, it's useless.
Okay, so are we going to see a full-out ban?
There's no chance. We've seen all this data. TikTok has 150 million American users. Almost all of them are under the age of 35. That is like 45% of the U.S. population. By the way, the percentage of members of Congress who use TikTok is around 5 or 6%. So this is something many Americans are familiar with. Most members of Congress are not familiar with, and that shows up in the hearings when you get some dumb questions and things like that. Everybody thinks that young people don't vote as much as old people. That's true, but they do vote. And Democrats, they tend to be Democrats or vote Democratic, and Democrats think young people are actually decisive in the 2022 midterm elections, which helped them underperform, bigger turnout from younger voters. So the Commerce Secretary Gina Raimondo said, what I feel like what happened here, if you ban TikTok, you instantly lose 150 million voters forever. And I think that's about right. So the reason you're not hearing any Democrats in Congress defending TikTok is because it's owned by this Chinese company, ByteDance. You can no longer defend anything associated with China. Everybody in Washington has to be tough on China, at least verbally. But they are not gonna let Congress ban TikTok. The Democrats still control the Senate, and I think there's just about zero chance that there will actually be a bill that could pass Congress that will ban TikTok.
So if you don't see any changes coming to TikTok, what was also interesting, and the CEO of TikTok brought this up, just about the fact that even U.S. social media platforms, they have failed to prevent a lot of the misinformation, a lot of the criticism on their site. Do you see those types of issues continuing to get bipartisan agreement, and one area where both sides of the aisle may continue to agree on, at least over the next couple of years?
So there's different types of bipartisan agreement. The bipartisan agreement we're talking about here is a bipartisan agreement to just complain about social media. I mean, how long has Congress been complaining about social media? What's it doing to our kids? It's ruining, and when, the TikTok CEO testified last week, you heard a lot of criticism directed at him that was just criticism of social media in general. Yeah. It wasn't particular to TikTok. So, I think that right there tells you how muddled this is. There's been a lot of talk about possible legislation of other types of social media, Section 230 of the Communications Decency Acts and so on. We've been hearing about that for years. Nothing has happened. So I think this is just one of those issues that is kind of like a golden oldie, or becoming that in Washington, which is members of Congress and politicians think it's important for them to take a verbal stand. They want to be tough on these companies, but I don't think there's any member of Congress who will cast the deciding vote to put TikTok out of business.
100% agree with you on that, and I went off on that for a while. But what will happen, because Senator Lummis from Wyoming said either it needs a full-out ban or some type of assurance that that data is walled off from the Chinese Communist government. Are you saying nothing will happen?
So the threat of a ban is actually useful because kind of behind the scenes, this agency called CFIUS has been negotiating with TikTok about ways to make sure this data is not abused or does not make its way back to the Chinese government somehow. By the way, there's no evidence that any of that data is going back to the Chinese government. You could set up systems that are designed to watch for that happening. There have been some proposals that you set up a watchdog operation, and if this does become a problem, or when you do notice this is actually happening, the thing that we're worried about here is no longer theoretical, it's actually happening, then you take action. But to do it on a proactive or preemptive basis, when most people use this for entertainment, really is just kind of silly.
It's easy to get lost in TikTok. I'm one of those people. You start scrolling, and you can be there
Which
for
is
hours.
why the creators love TikTok,
know,
because
the
it gets you to stay
algorithm.
for a long time. Something sticky about it, right?
Yeah,
Never gone down the rabbit hole.
Really?
Never.
That's actually shocking to me for some
I
reason.
yeah, it is.
All right, Rick, thanks so much
to
for
see you,
breaking
man.
that down. When it comes to generative AI, it seems Microsoft is dominating the competition among big tech giants. Yahoo Finance tech editor Dan Halley here to weigh in. And Dan, I know you've been speaking with a lot of analysts on this. How big of a lead does Microsoft have?
They have a pretty decent lead right now, and it's mostly because of their investment in OpenAI. I think that's really where you're seeing Microsoft pull ahead. If it wasn't for that, it would still be talking about Google as really the AI leader. But now that they have OpenAI, they're not beholden to Microsoft by any stretch of the imagination. But Microsoft did make that multi-billion-dollar investment over several years. So they really do have that kind of as the propellant for their rocket. And really, they're riding that. I'm going to try to keep this metaphor going. I don't know how much longer. Into
I
the
love
sun,
metaphors.
I guess.
Keep going.
But it's interesting because they weren't in this position too long ago, right? When you thought about AI, you didn't think about Microsoft. Everybody has AI, by the way. Every tech company uses AI to one degree or another. This generative AI, though, is really what we're all talking about right now. And so that's where, Google helped basically establish this technology. And now they're an also-ran. So it's interesting to see how the cards have kind of changed, right? Just as quickly as a month. And you look at what Microsoft has to offer right now as far as their generative AI capabilities. They have Microsoft Security Copilot, Microsoft 365 Copilot, Microsoft Dynamics 365 Copilot. They have Bing, they have Teams, they have Edge. So they're throwing this Skype into everything they have. And I think that's really why we're seeing Microsoft just kind of keep running with this while we're still waiting for Google to figure out what they're doing.
So they're really the Tesla if you compare it to the EV space. So who's closest to Microsoft's bumper?
Right now, Google. Still, yeah. I mean, they're.
We wanted more metaphors, man.
They're on a collision course. What else?
We need a bell.
We
do.
Microsoft is still burning rubber, though. I would say, as far as this goes, they have the better charge. I'm going to stop. But yeah, I do think that it's mostly Google at this point. Meta is working on it. They said specifically, Mark Zuckerberg has said, look, we're building a team for generative AI. Amazon is in it. One of the things, one of the analysts that I spoke to said that's interesting, though, is look, Microsoft has this big lead right now. They've also driven a lot of interest. And that, in turn, means that smaller companies are getting in there. And they're going to perhaps be the next disruptors that really start to throw a wrench into the works for Microsoft. So it might not necessarily be Google. It might be another startup that comes along and says, hey, we have this awesome idea for generative AI. We have this wild scheme that's going to drive people nuts. And I think, the next thing that you should look for is what they call multimodal, where you'll be able to use a text box to generate video, image, and text all in one. And that's where we're going to see it next.
That was all very impressive. The metaphors just kept going and going and
It's
going.
your turn, man.
Revving up in the middle. There we go. Yeah, but
she's going to hit the brakes on this segment.
Yeah, we will hit the brakes on this segment. We got to go. Hallie, awesome. Thanks so much. Coming up, we will break down some of the biggest takeaways from today's top stories. Stick around. It's closing time here at Yahoo Finance. Let's recap some of the biggest stories of the day. Banking regulators returning to Capitol Hill for a second day of questioning. Both Democrats and Republicans on the House Financial Services Committee seem to agree that regulators did not do enough to stop the collapse of Silicon Valley Bank, with Democratic Congressman Juan Vargas saying that it seemed like SVB management, quote, blew you guys off and you didn't do anything. The Fed's investigation into the collapse of SVB is set to be released by May 1st.
On the other side of the Capitol, former Starbucks CEO Howard Schultz squared off with Senator Bernie Sanders over the company's labor practices. Senator Sanders accusing the company of union busting, while Schultz, as you might expect, disagreed and insisted throughout the hearing that Starbucks unequivocally has not broken the law.
And finally, Apple announcing its big developers conference will be held June 5th through the 9th. Now, the keynote will be held on the 5th. Apple is expected to show off its latest operating systems, with the speculation that the company could unveil its long-awaited virtual and augmented reality headset.
That'll do it for us on Yahoo Finance Live. Be sure to come back tomorrow, 3 o'clock Eastern Time. All your coverage leading up to and after the closing bell.